Welcome to Sprague Energy's market brief for March 9th, 2012. We've taken about a week off here. I'm Taylor Hudson and joined by Hugh McNaughton. So today what we thought we'd talk about is the rising occurrence of news stories and articles that are beginning to question whether or not the rise in energy prices is going to have a negative effect on the global economy and the U.S. economy in particular. We think it's important before we get started. We're not going to spend a whole lot of time today talking necessarily about crude oil prices or heating oil prices. We're going to talk generally about gasoline prices, and that's because, as you can see from this chart, when we talk about the impact of energy prices on the overall economy, we're really talking about transportation impact. So we're talking about diesel fuel and we're talking about transportation. So let's go back to a little period of time about a year ago, and we're reading a lot of articles today that have headlines like "This time is different," and it reminds us of the fact that if you look at the first quarter of 2011, we had a very large run in energy prices, gasoline in particular, and this chart here shows that in about 3 months' time, we went from roughly $2.40 for gasoline all the way up to $3.50. Now that's on the NYMEX. It's not a pump price, but retail prices followed suit. We had about $1 rally in just under 3 months. Now, for
by golly, Taylor, look at the difference. 20 cents. 3 months, that's the same, 20 cents. And what did you say you saw the guy filling his pickup truck today saying, gosh, whatever this truck takes forever to fill, something along those lines? So really, this year is different. It's going to have to be something other than the magnitude of the run-up in gasoline prices in just a period of 3 months. And in fact, what might be different is summarized here in this slide, which is our final slide, by the way. So everybody gets off early tonight. We've got two camps, two very distinct points of view. And here's how we have summarized them. On the left-hand side are the proponents of the argument that things really are different this year. There are major differences between what caused yesterday's economic derailment and what we're looking forward to this year. And then on the right-hand side, as you can see, are the people who express the sentiment that we are in trouble, that there are serious danger signs ahead. So just quickly, wages are increasing. Yes, they are. This is a very strong argument that the economy is on a sounder footing and that as long as personal income is going up, which it is, then it's going to be enough to compensate for the higher costs of energy. We did have a warm winter. It didn't really benefit people paying $3.70 a gallon or $4 for that matter, heating oil in the Northeast. But certainly for the majority of the country that heats their houses with natural gas, it was a substantial benefit. The stock market, it continues to flirt. Dow Jones flirts with 13,000, hasn't got there yet. But I mean, are all those smart money men and women really ignoring the fact that energy costs are creeping up on us and going to throw stock market back down into a major slide?
No, they know that Facebook is going to go public soon, Hugh.
Yeah, well, that might account for it, for sure. And finally, you can't argue that the unemployment or put it this way, the economy is adding more jobs. Unemployment may not be going down, but but the labor force is going up anyway. Whether on whatever political footing you stand here, the argument can be made that the economy is in a much better position to withstand the kind of shock that we're looking at than it was last year. Lastly, over on the other side, John Kemp, the always impressive analyst and one of our favorites, makes the point of view that the leading indicators, all of those over on the left-hand side, are way too premature to really identify the extent to which we are in peril, so to speak. Higher prices, as many other commentators report, have a cumulative effect. It's not just a one-tank fill-up. This is where a five-tank fill-up eventually has an impact on the wallet. And lastly, as Taylor has very cleverly done here, look at that $4 gas price in the story above, and then look at the date. And tell us whether you really think things are different. What's your take on this all, Taylor?
Well, it's interesting when we sit down and debate these things. The first thing on the optimist side, I really didn't, I hadn't been paying attention too much to the wage growth, and it's interesting to read about it. It seems fairly strong. The Bureau of Economic Analysis has recently revised upward wage growth, and you can't argue with the fact that if people have some more money in their pocket to spend, that if they spend a little bit more at the pump, maybe it won't matter as much. Also, in terms of sort of economic indicators, consumer confidence has been going up. At the tail end of last year, the indicator was 54-ish. In January, we got a 61.5 reading, and in February, we got a 71 reading. So people feel a little bit better. Also read an interesting statistic, and that was that the increase in energy spend for the U.S. in total, with the run-up in pricing, is about $6.9 billion. Sounds like a lot, right? I mean, it's $6.9 billion. However, when you compare it to total consumer spending in a year of $11 trillion, you start to realize that the increase is less than 1%.
Pretty insignificant.
Yeah, not as large as maybe you think after you fill the tank. And then finally, I don't think I can argue with the fact that it does look like the economic outlook is stronger. In my opinion, Europe has calmed down quite a bit since this fall and last year when we had near pandemonium every day on CNBC. These loan programs seem to have calmed the bond markets over there, and I think that this Greece thing is working out, and I don't think that that's as much of a time bomb. Also, you have the Bank of Japan and the European Central Bank this year versus last year adopting these liquidity measures like the Fed. So they weren't there last year, and they are this year. That helps. And I'm going to assume that the tsunami, I hope, was a 10,000-year event, and that something of that magnitude is just not likely to happen again. I hope for everybody's sake that it won't. And I think that was a real monkey wrench that got thrown in. Finally, just a couple of other points on the sort of what me worry camp. Driving to work the other day, listening to Marketplace in the morning, and they had a survey on, and the survey said that U.S. consumers are not apt to change their driving habits significantly unless gas prices get to, now hold your horse, $5.36 a gallon. Now I did the math for my car, 15 gallons, that's $80. So they're saying that unless I'm breaking out 420s for my fill up, I'm probably not going to change my style. And like you alluded to earlier, I heard a guy say while I was filling up, he doesn't care how high gas prices go, he'll never give up his truck. So these camps for me are interesting, and at the same time, I do look at the this time is not different though, and I agree that who knows what tomorrow holds. And let's face it, if I have less money because I'm paying more for my transportation energy, I got less money for something else. What do you think?
Okay, well, Taylor, we're getting a lot of feedback from our dedicated listeners here about the fantastic job we're doing of presenting a balanced and analytical argument on both sides of the question, saying, but what do you guys think? Which, of course, is going to lead to multi-million lawsuits as soon as we make a prediction. However, on a very general basis, I'm with Alfred E. Newman. I'm a little bit of a cockeyed optimist here. I think there are a substantial amount of factors that are different this year. And yes, it may be premature, and it is a fact that every cent spent on gasoline is another cent less for Walmart or Neiman Marcus or wherever you shop, Taylor. Uh, I'm more of the former than the latter, by the way. So I'm prepared to give this situation the benefit of the doubt. What do you think?
Um, that was a really nice sit on the fence job there. No, just kidding. Uh, I do think that the economy's in a little stronger position than it was last year. So I'm going to give. I don't think we're going to see any major pullbacks in any of the markets anytime soon. I think the economy is going to withstand this headwind a little bit, and at the end of the day, too, we do have this Iran issue out there that's holding the energy markets up. So, I know we're not talking about Iran today, but I see that as putting sort of a floor under this market for a while. So that's what I think. You want to
Okay.
take us out?
All right. Well, Taylor, I agree. Unfortunately, I think, obviously speaking for both of us, lower energy prices aren't necessarily very much in the future here. We're stuck with them for the time being, as much as I wish we could say otherwise. So, under those circumstances, thank you for your time, and for listening to us. Hope you have a great weekend. And Taylor, we'll wrap it up.
Thanks very much.